Welcome everyone to the Kendall Report. In this video, what I'm going to do is lay out a trading pattern that I think is going to exist for the next several months, and it's going to set up an opportunity for us to all make a lot of money scalping in the range that I believe the market will be stuck in for at least 3 to 6 months. Let's get into it. Make sure that you subscribe and like these videos so the YouTube algorithm will know that I'm doing a good job for you folks. Welcome everyone. I'm going to be going through a lot of detail on how to trade volatility. It's something that I have focused on for about 31 years. Those of you that have watched my channel know I talk about the market grid all the time, and that really has everything to do with the vision of how I trade and how I set up trades using those ranges or those expected ranges. There's been a lot of studies over the years, and I do something I think a little different than a lot of folks. You can go back to people like Parkinson in 1980, where they were looking at some very complex equations trying to come up with the ranges for the next day. Well, this whole background for me has been based upon years of just looking at charts and doing some Fibonacci relationships, and I always use 3 and 5 day relationships and patterns. So this is where the market grid came from. This video is a lot about those concepts and philosophies that guide that. As I mentioned in the opening part of the video, is I believe we're going to be stuck in a range for multiple months. We've seen this if you've watched the channel, and Tesla and a lot of the big stocks out there where they make these big giant volatility moves and they go sideways for multiple months. I believe that's what we did in January as we saw the S&P go from 48.18 all the way down to 42.22. I will show you here in a couple of minutes. In fact, we've been trading in that range since September of last year, and I believe this is going to continue just because of all the uncertainty around the markets right now with what's going on with the Fed and other things from that standpoint. But I want to talk about this range volatility concept before we get into actually setting up how to trade it. Markets do trade in somewhat expected ranges. And when I use the term somewhat, that is a quant term, that there is some predictability to the outcome. And this is something, like I said, I've studied for about 31 years now, and this is an important part of my analysis that I do every day on the channel, and it also carries out to the monthly or the secular charts, which is what we're going to focus on here in a few minutes, as well as the intermediate and short term. And you can use this all the way down into a 5-minute and a 1-minute chart. Those of you that are in our live trading room know that I use the same methodology on a 1-minute graph and a 5 to combine them together to day trade. Let's go ahead and dig into some of the patterns that I think you're going to need to understand over the next several months. I think it could be as many as 6 months before we see any changes here. So let's take a look at the charts. The primary chart that we're going to pay attention to, at least in the interim here, is the S&P cash monthly chart. And this is really what it's all about. I talked about this on one of my streams last week, and I realized that this was actually the setup going forward. And I'm going to go through plenty of details. So let's take a look at this. Now I have left the market grid on there. So this is the monthly market grid, and this is an adaptive pattern that you're seeing here. So I also put a static Fibonacci grid on here so we can look at the differences and talk about some of the ranges that I think we're going to need to pay attention to. We look at the highs at 48.18 and the lows at 42.22, and there's several values come into play here. We're looking at the 50% line, which is 45.20. Then we have the 0.618, 45.90. We actually printed that last week in the first full week of February. Now what we're seeing here is the potential for a 46 handle coming on to 46.77. But I think primarily, if you look at the market grid, let's take a look at those numbers that are set up the month of February. I also discuss this a lot, that oftentimes the market grid gets into what I call a square formation. It flattens out, and it will stay like that until we see volatility even contract basis the market grid. If you recall my comments just a few minutes ago, it's adapting to 3 and 5 bar volatility and then recalculating what the range is likely to be based on that volatility, not on a pure Fibonacci viewpoint. So the numbers I just mentioned are pure Fibonacci numbers. Most likely what we're going to see in the market grid itself is a contracting grid over the next couple months. So we may see the range expectations start to drop down. We had the big range in January. Now we're looking at the range of starting to contract over the next couple months. Because if we do stay within this is my premise, that we're going to stay between the 48.18 and the 42.22 levels. If we're going to stay in those ranges, then we're likely to stay within these Fibonacci sequences, but we're also likely to stay within the market grid expectations. A few minutes ago, I used the term somewhat, and I want you to understand that the term somewhat means that there is predictability for this. And this is why you'll see only about 12% of the time the market grid will break above the outer bounds or the lower bounds of what's being projected. So it's very accurate most of the time. Otherwise, about 1 out of 10 times it will break out. There's actually one breakout right here back in 10/29 of 2021, and the last one before that was back in 2020 on November. So it was just about a year apart. They don't happen often, especially on these secular charts. But I mentioned something else just a few minutes ago. I mentioned that we've been basically in the same range since going back to September. It's actually going back to July of 2021. And you'll look here and you'll see the low was 42.43 in July. Now the market continued to move higher in this pattern, but we look at the January's low. What do we see? 42.22. So we went 10 points under that, and then we saw this big bounce back into the range. This range that I'm talking about here is likely to continue. Now I'm going to draw in a number of potential expectations on how this might look from a pattern viewpoint. So from a pattern viewpoint, what we're likely to start to see is something setting up with a zigzag formation and all of these bars staying within these ranges. As I mentioned, at least 3 months, and the reason why I come up with 6 is typically when we get into these patterns, we'll get somewhere between 3 and 5 patterns. It'll even extend out as far as 8 months or 8 bars in this case. But we're likely to just stay in this range. So if we know that we have a reasonable expectation where the high and low of the market's going to be, what does that mean for trading? What that means is we now have the opportunity to do straddles. We can collect premiums on S&P options, selling puts, selling calls, doing big straddles, doing those type of things. We also know that we can trade off of these lows with a reasonable amount of expected risk when we get to these levels. And over the next several weeks, if you watch the Kendall Report channel, I'll be talking about these numbers, setting them up in real time. Right now, all we can do is actually talk about the expectations of the numbers, not so much what the numbers are actually going to be as we go from day to day and week to week over the next several months. So we should be able to set up these expectations, the lower bounds and the higher bounds. And right now, just looking at the configuration, we're looking at the 0.76 level, which is going to be 46.77 on the upside. On the downside, we're looking at the 43.82 level. If I were to bring up a daily chart, there's a big pivot number at 43.58. And I've said before, I think that's rock solid in that formation. We should be able to really set up a lot of things here. Well, folks, in conclusion with this video, I've got you set up for at least understanding the expected range. You can use this range in January for the NASDAQ as well, and I think you can set up the Fibonacci numbers and all of the elements that I talked about. I expose a lot of these numbers on my channel every day, so you'll have an idea of what to expect from the standpoint of where the market grid is and some of these Fibonacci numbers as we go forward. Just a reminder is that it is important to understand that this range is going to be very erratic, highly volatile. We're likely to see volatility stay high for at least another 3, as much as 5 months, as I mentioned earlier. So be cautious here, but there is going to be a ton of opportunity in this range. And I'll be covering this on the channel from time to time. And I do plan on a follow-up video to talk about the 10 best correlated stocks that you can trade in this range. So look forward to that video that will be coming out fairly soon. Thanks again for watching. Remember to subscribe, like, and share these videos, and we'll see you on my daily streams.